depending on your stage of life, what your objectives are, what you're trying to accomplish, if you're going to need to start taking income out, diversification is still valuable. Risk management is critical, right?
All thoughts and opinions shared in this recording belong to the participants. This podcast is meant to inform and educate and should not be seen as solicitation or endorsement for business.
Welcome to the Market Moment. This is Matt Walters here with Lee Mackey.
Good morning.
And Eli Freeman.
Hello, hello.
We got Eli on the podcast.
Welcome back, man.
Excited to be here. Excited.
It's been a minute.
New year.
Yeah,
New
that's
year.
Right.
Eli got his CFP
We told you
last year.
We told you guys for a while now, we've got big goals on improving the podcast. So step one was getting John off and looping Eli back in. No, I'm kidding.
My mom loves John.
John's actually really good on the podcast. So
Yeah.
I'm kidding. He's just taking a week off. So Eli jumping in here with us.
Glad to have you back in the rotation.
Oh, yeah.
It was a busy year for you last year.
Oh, yeah. Finished up CFP and then just the data brief series. I don't know if anyone watches that. Hopefully a few people watch it. But the data brief series took a decent amount of my time.
Yeah.
We were planning ahead on that. So
yeah. And like we always say on the podcast, on the data brief as well, if you guys ever have any ideas or topics that you want us to talk about, want Eli to talk about on the data brief, feel free to email those over to the podcast email.
Especially
or shoot it over in a comment.
For mine, it's data heavy
Yeah.
content. So if you have pretty technical questions, things that you want someone to break down, spend some time on, that's exactly what I'm doing in those video series.
You're talking about facts. This is just like an op-ed podcast. Like,
Exactly.
There's no soap opera in the data brief.
No, it's just the facts, ma'am. Just the facts.
Yeah. So today we're going to talk about a couple things. First and foremost, we're going to talk about what's going on in the bond market. So, the Fed started its rate cutting cycle, was it in July last summer?
Mid last year.
Yeah, so last summer started cutting rates. Everybody's like, oh, thankfully rates are going to start coming down. Mm-hmm. We're going to see some relief in mortgage rates, right?
And we did.
And we did for the very first few months of that. And then the last few months, we've started to see a rally, like in the 10-year, for example, which is what really drives like things such as like mortgage rates, mm-hmm. right? And so we've started to see a rally in that where the Fed has cut rates a couple more times, but the 10-year is the highest it's been in a very, very long time, right? And so what's going on there? The fixed income space is a really kind of complicated space, right?
Yeah.
There's a lot of moving parts. It's not that the equity markets are easy by any stretch of the imagination, but understanding how the fixed income markets move, why they move, how they're being priced, it's tough. It's hard.
When you listen to fixed income managers, people who manage funds of fixed income, the things and the concerns that they're talking about are so long, mm-hmm. macroeconomic questions of 5-year, 10-year, 20-year questions that they're trying to price into these. It's crazy as you listen to fixed income relative to equities where they're gauged month by month on their performance.
Yeah.
The fixed income world is just a fascinating and terrifying world.
Yeah. So my understanding, the 10 years rallied. So, mortgage rates have gone up. We were just talking about it before we got here on the podcast. My understanding of the situation is a lot of it, the bond, they're kind of like the bond vigilantes, like the bond investors that are kind of putting their foot down and saying, hey, if we're going to continue to buy this debt, if we're going to continue to buy treasuries, let's look at the treasury market. We need to be paid the yield because these things aren't as, low risk or risk free as maybe they're marketed to be because of the sovereign debt situation around the world, not just unique to the U.S., but literally all around the world. There is a debt, nations and countries find themselves in a less than ideal debt situation. And so,
and compared to some countries in Europe, the U.S.'s debt situation's pretty good. I mean,
sure.
There are some countries in the EU that
are in a tough spot.
Very tough spot.
And the market's basically saying, hey, we'll keep buying this debt, but you're going to have to pay us for it.
Yeah.
We're not going to continue to do this at lower and lower yields. Like, we're going to hold the yields up so that we get rewarded, that there's more of a natural risk reward relationship.
So what does that cause? Like a higher treasury, what are some of the implications for investors as they're looking at their portfolios or looking at?
Well, I mean, if a fixed income portfolio has higher yield, one, I look at it as a generally positive thing because it does what you need it to do, right? It produces yield. And hopefully it creates the opportunity for appreciation if rates do at some point start to come down. They don't even have to come down materially, right? The appreciation is kind of the secondary component to being a fixed income investor.
But right now, as rates have trended higher, it's worked against both markets.
Sure.
I mean, the equity markets have sold off because, you know, there are investors out there that can say, you know what, why would I expose my money to risk when I can go into and get 5-6% in the treasury market? And then two, if you're holding bonds and rates move up, your valuations are going down. So this trend that we've seen higher has negatively affected both the equity markets and the fixed income markets.
And I think there could be some timing to what your first point was. We've had back-to-back 20% return years in the S&P 500. Anyone's looking at their portfolio and saying, okay, I needed a 7% rate of return to make my retirement plan work, and I've had 15, 17% returns back-to-back, and now I can go get 5% on something that's very low to no risk. Well, that starts to make a pretty compelling story. That or go buy another home, right?
Yeah.
you start to get competing objectives of my equities have outperformed anything that I would expect.
For so long, the only place, the only area to make money was the equity market.
Right. And the 60
for years.
The 60-40 over time grew into like the 70-30, 80-20.
Sure.
Oh, yeah.
It had to. You had to naturally decrease your fixed income exposure to generate the returns that you needed and wanted. And now that's reversing. And so if the fixed income market's going to be producing yield, have better opportunities for price appreciation over the longer term, then that 60-40, going back to a true 60-40, is going to take money out of the equity markets and into the fixed income market. Mm-hmm. So I think your point or your question, Eli, I mean, I see it as a generally positive thing over the long term. In the short term, like anything, right, it can create some instability or, some people might even be negatively impacted that thought they were going to see some appreciation opportunities in the shorter term, and that hasn't been realized. But I think it's a good thing. And it as we've been building portfolios, we've been having this conversation internally. Sure. How do we make adjustments and how do we, adapt and adjust to these moving markets? It creates a lot more opportunity where we're saying, hey, like there's a lot of opportunity in the fixed income market that we haven't been that attracted to for 10 to 15 years.
Well, yeah, you go back several years and we were talking about bond proxies.
Yeah,
what should we use instead of bonds? Because bonds are paying us nothing worth holding.
Yeah.
They're paying us 1% to hold on.
I mean, for years, one of the proxies I used was dividend-paying stocks.
Utilities.
Yeah. Go buy AT&T.
Yeah, go buy Verizon with a 7% yield, and if it goes down 4 or 5%, who cares? You're getting a great.
Don't sell it.
Yeah, just hold it. And so, the one thing we haven't mentioned, too, guys, is the markets have been priced to perfection. I mean, just there was so little room for error or for something not to go right. It was probably this time last year, and the markets had how many? 8, 10 rate cuts, in the queue for the next 2 years through this year. And we've gotten 3, and we might get 2 this year, maybe 3. Inflation, we got the scare last week with the jobs number, and that sent the 10-year almost to 4.8. And I don't know, when was the last time it hit 4.8? A year ago? 2 years?
Well, it hit it about a year ago.
Yeah.
But previous to that, it was 2007.
So, I mean, we're up in some air that we haven't seen in a long time. And that is the reason why the market's sold off.
But, I mean, if you start looking at the fundamentals of what's going on, we have unemployment rate that's really low. We have inflation that's trending down towards 2% from a high of 9.6%. You've got year-over-year earnings that are growing rapidly.
Sure.
Last year, profit margins increased by 8% in the S&P 500. And now we can use diversification on our fixed income portfolio. I don't know how an investor can currently complain.
Yeah.
Like we're sitting in a time where the worst part and where people are frustrated is because diversification out of large cap tech hasn't worked well.
Yeah. The most frustrating part of for us as professionals and us as individual investors has been, if you've been diversified, you haven't just kept up with the sticker price of the S&P 500,
Correct.
right? Or the NASDAQ 100. And that over sustained longer periods of time can get very frustrating, because you're like, well, the S&P is this, and then it does it again the next
Yeah.
year. And
Why
you're
do I
like,
have international stocks?
yeah. It's like,
Yeah.
what is this small cap? What is this fixed income, mid cap, international exposure? Like, why is it even there? Like, it's not doing anything for me, right? And it's human nature, completely natural. Everyone does it. I think the first thing that you have to be aware of is just accepting and knowing that, like, this is going to be natural to feel this, but doesn't mean you might need to make adjustments, but doesn't necessarily mean you need to make huge shifts in your portfolio just because of what's worked or not worked in the last few years.
And when you say last few years, you mean since 2009.
Yeah.
Like
15 years.
We defined few different. But that's
Yeah,
fine.
yeah, a couple.
Like, you look at a portfolio and you start to break down what's contributed to the returns of the portfolio. Large cap tech, the Mag 7, even extended from Mag 7, some companies extended out, have just bulldogged their way to the returns. And the remaining are just sitting like chihuahuas on the side. Please don't clip that.
Yeah.
But you have these small companies, international companies, medium-sized companies. Anything outside of the S&P 500 has just looked like a drag on a portfolio.
Sure.
And to say there's a reason to hold it's difficult.
It is difficult, for sure. No, it absolutely is. And I think this goes back to, we've spent a lot of time over the last few years on the podcast and different series that we've done talking about planning, right? And like knowing what your objectives are. And I think as an investor, a lot of people, they find themselves slipping back into kind of the trap of the lie of, my objective is the highest return possible. And for some people younger in life, you're in the growth stages, right? You're investing aggressively and contributing. You're not taking anything out. That might and probably should be your sole or at least number one objective. But for a lot of people that are 50, 55 plus, nearing retirement, getting close to retirement, your number one objective probably should not be like max return possible, right? It's more about sequence of returns, maximizing returns within a range of potential outcomes, right? Minimizing the drawdowns, the extremes. And that's where it can get hard, because you are maybe more broadly diversified. You're trying to take less risk and manage that risk in different ways. And so you look at your portfolio and you're like, man, I've got stuff in here that hasn't worked for a while.
Yeah.
Yeah. Or it's positive, but it's up a lot less than some of this large cap technology exposure that I have. But just staying to the course of like, what is my objective? Is my objective, trying to get a steady 7-8% annualized return? Have I been achieving that? And how do I go about trying to continue to achieve that even when, the market shifts and evolves? But it's hard. And that's why I think having someone, an advisor, accountability partner, an investing buddy who's, up to speed on their stuff and knows what they're talking about to kind of hold you accountable and talk through.
And I think a lot of advisors are focused on that holistic approach, that risk-based side of investing. And, I haven't met many advisors who, their selling point is, I'm going to get you the best return ever, every year. It's, you talk to your clients and, if you're a middle of the road, moderate, balanced investor, your expectations have probably been exceeded over the last several years in this pretty robust bull market even.
Well, what's made it even harder over the last handful of years is there have been a lot of people make fortunes in short periods of time through different avenues, right? Whether it be cryptocurrency or whatever it may be.
NVIDIA play.
Trading options. And there have been legitimate fortunes made, lots of money made out there in very short periods of time. And I think it shifts our expectations in terms of what's possible, what's realistic. and we try to condense down into what we should be trying to achieve over a 10, 15, 20-year period. We see someone else do it. We read a news article about, one person that was successful. It doesn't talk about the 10 people who blew themselves up, but they talk about the one person that was successful doing it. And and we're attracted to that. And we're like, okay, now I want to try to achieve what I was going to in 10 years and do it in the next 2 or 3, right? And we kind of get out over our skis a little bit. And that's typically when people blow themselves up.
And it just goes, investing is emotional. I mean, it's, clients typically have short-term memories, which can be good. And
advisors do too.
Absolutely.
Advisors, we find ourselves talking so much about things that probably sometimes don't even have really big parts to play in clients' plans. Like we're talking about 10-year treasury yields when really like it does play into it. But it doesn't affect them in any material way.
Correct.
Like we all have that recency bias, and it's difficult from an advisor-client relationship to get to the things that truly matter for the plan.
Yeah.
Right.
Good point.
Yep. Well,
I heard something funny. Bring it back to a more jovial. Why do you think people hold international stocks? I heard this was a podcast that we listened to.
I think I know what you're going to say. So I'm not gonna say
Why do you think people hold international stocks?
I don't know.
To make small caps look good. Why do you think people hold small caps?
To make large caps look good.
Yes. 10-year returns international. So this is Vanguard VXUS.
Yeah.
Annualized 5%. 10-year Russell 2000 total return 7.8. 10-year VTI, so Vanguard total, which is basically a large cap.
Yeah.
12.6. I mean,
wow,
that's tough.
It's tough. Very tough.
Yep. Yeah. And the worst thing you can do, not saying you shouldn't do it, but from a having the right perspective or staying the course is like run that out in an Excel spreadsheet and say what would have been, like
oh yeah,
you're like I could have shoot, and then it just makes it that much harder to not make short-term decisions
for sure.
So anyways, just have a plan. Diversification, I think the whole point of this conversation was diversification is still valuable. Risk management is critical, right? Depending on your stage of life, what your objectives are, what you're trying to accomplish. If you're going to need to start taking income out in the next, some people think, well, I can stay aggressive up until right before I retire, right? And I oftentimes talk about the retirement red zone, and it's kind of the 5 years leading up to retirement and the first 5 years in retirement. I know the red zone is 20 yards, but mine's 10.
It's all right.
But it's that 10-year window where I often tell clients, if we're ever going to be slightly on the more conservative side, it makes the most sense in that 10-year window. If you run the numbers out and say, when is the worst window of time to have like a material drawdown, it's right before retirement and right after. And so as you start getting closer, 5, 6, 7 years to retirement, like you probably need to start, I'm not saying big adjustments, start making incremental small adjustments to decrease your risk. You're really gambling and probably taking too much risk if you stay full risk on right up until the date, right?
Sure.
And so,
well, and what a time to be able to say, I can diversify out. I can go buy small caps, the cheapest that they've been historically. International, cheapest relative, right? Small caps and international, very cheap. Large caps are pretty expensive right now, but all of the options outside of large cap are really fairly priced.
Sure.
Small caps, mid caps, international, and bonds that are paying 5%.
Well, and I'd even throw large cap value in there. I mean, it has not kept up with the large cap growth.
Just no one pull up any of the 10-year return histories of all those asset classes that I just said.
Yeah. And if you go do it, have the right timeline for expecting it to perform.
Correct.
It may not happen in the next year or two, right? But it doesn't mean it's bad. It's the wrong thing to have that as a part of your allocation. So we're still a huge believer in the markets, obviously, but we just think that you should have exposure to various parts of the market. A lot of people should start looking at allocating to some fixed income if you're needing to manage your risk.
Yes.
Hopefully, it should do a little better for the portfolio than it has over the last 10 to 15 years.
Yeah.
So, any parting thoughts or words or nuggets of advice. I had, the podcast Eli was referencing, the Compounded Friends. We listened to it regularly, every week, and Doug Bonaparte was on there.
Mm-hmm.
I think that's his name, isn't it?
Yeah, Bonafide Investments.
Yeah, Bonafide Investments or something like that in New York. He said, he's like, man, I've been waiting on, the Fed to cut rates, and I'm so glad I can finally refinance my 6.5% mortgage into a 7% mortgage.
Yeah. That's about right.
Yeah, and I was like, it's so true. Like, people have been talking about, like, I hope the Fed cuts rates, and a lot of it's been for first-time home buyers or people needing to move or looking to move, and it's not working the way we thought.
It's backed up.
Prices haven't reverted either.
Yeah, and prices. Yeah, the appreciation has slowed down, but it has not come down at all. Really good conversation. Super excited about 2025. What the markets have in store for us this year. Always fun.
What an exciting time.
We used to do headlines. We'd in our podcast, but this is a busy time of year right now. You got obviously the horrific fires out in California, but you've got a huge Supreme Court decision that is expected here in the coming weeks regarding TikTok. From a business perspective, yesterday a report in Bloomberg indicated that the Chinese government is looking at possibly selling off the U.S. To Elon Musk, selling the U.S. operations to Musk. You've got.
I like Musk, but it's like I need him to go away for a while.
Yeah, he's kind of dominated the airwaves lately.
Golly.
But anyway, there's just a lot of headlines.
Yeah.
The Senate confirmation hearings begin this week, which, will roll into probably the next 3 weeks. But you got an inauguration next Monday. So, I mean, this is a busy time for both business, political, and so forth.
This year, we've got a lot of changes coming down the pipe for taxes that we get to sit on the back seat and just watch. Are Trump's tax cuts, estate tax cuts, going to extend, or are they not? That's something huge for just a planning opportunity.
Sure.
That clients are needing to keep.
I'm
up
sure
with.
someone saw it coming, but I'm not nearly intelligent enough to go into the new year and say, like, you know what? I have a feeling the Chinese government's going to sell TikTok U.S. operations to Elon Musk. Like,
But why not?
yeah, but what the heck?
Trump's tax cuts. That's going to be something fun to watch.
Oh, yeah.
As Congress gets settled in. I'm hedging there. I think that a lot of the cuts will be extended, but I think that the Republicans are going to have to give something. So I think you could see some give and take there. Some rates may go up, but I think by and large, I think they will get them.
The hard part
extended.
where Trump and his administration is things are really good, right? Yeah. Generally speaking. Now, there's not for everybody, right? But for middle America up, things are pretty good. Kind of tough to roll into that situation with everything going on and to continue that trend when we're also at a point in our nation's history from a debt perspective, from a spending perspective, where tough decisions need to be made. Yeah. I mean, if he does the job he needs to do, there's going to have to be hard decisions made that in the short term might not be the most popular and might not even look like they're the best decision based on how the markets or whatever adjust to it. But it doesn't mean it's not the right long-term decision. And
correct.
Can Trump get out of his own way and his administration to make those hard decisions to position us for the best opportunity for continued sustained success over the long term?
And that would be a shift from his previous presidency.
Sure.
Like, that'd be a pretty massive shift in
policy. Anyone who judges their presidency based on the S&P 500 performance,
100%.
Well, that's pretty volatile,
Yeah.
And that's a short-term perspective to have. So
sure. Yeah, but I mean, but to your point, the economy is in a place right now, strength-wise, where some of those hard decisions could be made, and you'd rather make them in a period like this.
1,000%.
So.
Yes. Yeah.
We'll see.
But we don't have a great track record of doing that.
No.
So
nobody wants to be the administration that makes those hard decisions.
Yeah.
Good conversation.
All for it.
Eli, it was fun having you.
Welcome back, my friend.
I was
Welcome
quickly
back.
reminded why we don't have you on here, because you're smarter than both of us.
No.
Pretty much. Come back.
But no, it was fun having you on here for sure. And we appreciate you guys listening. An exciting year coming up on the podcast. A lot of good topics that we're going to get into, and always trying to bring you the latest in news on the markets and the economy. So give us a like, subscribe, share it on social media. We appreciate you guys, and we'll see you next week.
Have a good week.
The hosts of the Market Moment podcast are employees of Mach 1 Financial Group, LLC. Mach 1 is a registered investment advisor located in Rogers, Arkansas. Mach 1 may only transact business in those states in which the firm maintains a notice filing or has qualified for an exemption or exclusion from registration. A copy of Mach 1's current written disclosure brochure is available through the SEC website and available at disclosures.mach1fg.com. Thank you for listening to the Market Moment podcast.